Hi everybody, Dana Sparks, broker of Maximum One Greater Atlanta Realtors, and today's contract tip has to do with earnest money. The topic is your earnest money is safe. What a buyer hears and what the contract says. So just want to touch base with y'all regarding a couple of things regarding earnest money and how safe is the earnest money and what does that mean to a buyer, and what does the contract say about a buyer getting their earnest money returned to them? So the first thing I want to point out is this is all discussed not only in license law, but these topics are discussed in the GAR contract form, Georgia Association of Realtors contract forms, and in the RE contract forms. So in the GAR contract form, this is in GAR F201, the purchase and sale agreement, and it is under paragraph B7, earnest money. This is where it talks about the disbursement of earnest money, and generally speaking, what happens with the earnest money. In the RE forms contract package, this is all discussed in RE1, the standard terms for the purchase of real property in Georgia. And this is all discussed in paragraph 3, earnest money. So that's where parties can find this information discussed actually in the contract. For you as a real estate agent, there are also license laws for agents and brokers regarding the handling of earnest money. And generally speaking, the contract forms have language in there to reflect what the license law is in Georgia. Now, if you are a real estate agent and you are working with a buyer and they go binding on a contract that is outside of the GAR purchase and sale agreement or the RE forms purchase and sale agreement, in other words, new construction, a HUD contract, a contract written for you by an attorney, then you will have to look at what that contract says regarding the disbursement of the earnest money, as well as consulting with license law. But you must keep in mind that if the holder of the earnest money is an attorney or a builder or someone who does not hold a real estate license, that person is not held to license law. License law just governs somebody that holds a real estate license issued to them by the state of Georgia, which would be a real estate agent or a broker. So now, generally speaking, the best, so you work with it, let's say you're an agent and you work with a buyer and you go find a house that the buyer wants to buy and you write an offer. Well, that seller is going to want earnest money as good faith money to secure the house, so to speak, for that buyer to say, look, yes, I am in earnest about going through with this purchase agreement. Should all the other contingencies pan out and the title be clear and unencumbered and good and marketable title, so forth and so on, I'm putting my money where my mouth is, so to speak, and here's my earnest money to get you, the seller, to accept my offer in the offer. And then should I default on the contract, then you get that earnest money as liquidated damages for my default. Now, that's all spelled out again in the GAR and the RE forms purchase and sale contract. So you work with the buyer, you find a house, you ask them for thousands and thousands of dollars of earnest money, and you as the agent, you tell the buyer, hey, your earnest money is safe. It is protected with a variety of clauses. It's protected under the due diligence period if we terminate prior to the end of that. It's protected if we don't meet a contingency and terminate the contract prior to the expiration of the contingency. So your earnest money is perfectly safe. So write a check to the holder for thousands and thousands and thousands of dollars. And then if we terminate, and you will get your earnest money back. Well, when you say you will get your earnest money back, what does the buyer hear? Well, the buyer hears their earnest money is safe. They will get it back. And they hear, when do they think they'll get it back? Yep, they think they're going to get it back immediately as soon as they sign a termination. Well, what does the contract say? Well, the contract says a whole lot of things. First of all, if the buyer does go under contract with the seller and they terminate regardless of the reason of the termination or the time frame. If they terminate under due diligence period or under a certain contingency that was agreed upon in the contract, the buyer must send a notice of termination that is signed by the buyer and a request to have the earnest money released back to them. Now, a notice of termination is unilateral, so it only requires the buyer's signature to terminate the contract. However, the disbursement of the earnest money of the trust funds does require agreement, meaning you must have both the buyer and the seller's signatures agreeing to how the holder can disperse those funds. Now, that is not only written in the contracts, that is also license law, that an agreement to disperse the trust funds, any sort of trust funds, must be agreed upon by the parties in a separate document that directed the holder to hold the earnest money or the trust funds in the first place. So what happens if you, the buyer's agent, the buyer terminates prior to the expiration of a contingency, whether it be the due diligence time frame or financing contingency, sale or lease contingency, appraisal contingency, any of the contingencies, and you send over that T&R, but the seller doesn't sign it? Well, if the seller doesn't sign it, the holder cannot automatically disperse. So let's look at the timing of all this. So let's say the buyer terminates a contract prior to the end of due diligence. You send over a T&R. Seller doesn't sign it. Well, as the agent, it's first going to take you a couple of days with your communication with the listing agent, to find out the seller's not going to sign the agreement to release the earnest money. So there's a couple of days right there that you don't realize you're going to get a signed T&R. Then you have to contact the holder of the earnest money. A lot of times agents aren't familiar with this, and they contact their broker and they'll say, what do I do? What do I do? Well, you have to contact the holder of the earnest money to let the holder of the earnest money know that the earnest money is in dispute, because the seller won't sign the agreement to disperse it back to the buyer. So you have to give all the required information to the holder. They need the parties' names, the parties' mailing addresses, email addresses, and a whole situation, the scenario of what happened, as well as a good holder is going to do some research and not only look at the termination document, but ask the buyer's agent, okay, now show me the email when you sent the buyer's termination to the seller. Because if the time frames are clearly spelled out in the contract, and the notice of termination must be done prior to the expiration of, in this example, due diligence or whatever the contingency is. So the termination, even if that is dated prior to the expiration of due diligence, the holder needs to have proof that the agent actually sent that termination prior to the expiration of due diligence. So if a buyer's terminating on the last day of due diligence, let's say, and the buyer signs it, but the agent doesn't send it till the next day, the buyer's in default because the notice has to be sent prior to the expiration. So a holder has to do a little bit of research to determine what happened, why did the contract fail to close, what was the reason for the termination, what were the notices that were sent, when were the notices sent, were they proper notices, so forth and so on. Then the holder does their interpretation of the contract, writes their notice of their intent to disperse the earnest money, sends it out to the parties, and then you have to wait 10 full days to go through any written objection that the holder may get and determine if there is a contractual basis for that objection. For example, maybe there was an amendment that was signed by the parties that the holder does not have in their records. Or if there is no other contractual reason to change their mind, then the earliest day would be the soonest business day after the 10th day. So day 11, the soonest business day from day 11 on, that the holder would disperse the funds. Then, how does the holder disperse the funds? Do they write a check and mail it out to the parties? Do they write a check and give it to the agent for the agent to give back to the buyer? Do they write a check and leave it at the branch for the buyer to come by and pick it up? Do they have a bill pay system through their bank where the bank sends it directly to the buyer? Does the holder have the mailing address of the buyer to release the funds back to? There's a whole variety of situations of how is it that once it is dispersed, that it gets to the buyer. That takes time. So from the time the buyer, let's in this example say they terminated on due diligence. From the time the buyer sent the notice of termination to due diligence, if a seller is not going to sign the release portion of a TNR, takes a couple days to do that. Then it may take a couple days for the holder to do their research to find out what happened. Did the buyer terminate by an agreed upon unexpired contingency, or did the buyer terminate by default? Write the notice of the intent to disperse the funds, wait a minimum of 10 days, and then disperse the funds on the first day after that 10 days. And typically it's going to be a business day to deal with the accounting department of that firm. And then how are those funds dispersed? That could take a few days there. So 10, 11, 12, 13, 14, weekend 15. We're looking at 14 to 17 potential days from the time a buyer has terminated a contract to get the actual earnest money. So let's say the buyer has terminated under due diligence. They terminate this house. They want to go buy another house. Well, what is seller number 2 going to want? Yeah, they're going to want earnest money also. Well, the earnest money on this purchase by house number 1 that has just been terminated, that money is tied up. It cannot be used as earnest money on contract number 2. So you, the agent, you have to go to the buyer and say, I need another check for thousands and thousands of dollars. And the buyer's like, what do you mean? I just gave you one check for thousands and thousands of dollars, and you said it was perfectly safe and I'd get it back if I terminated. Well, I terminated. You have it. I want to buy this house. What do you mean I need more money? You are asking me to write a check for more money. What do you think is going to happen to the relationship with that buyer if you have to ask them for thousands and thousands of dollars more because this earnest money is tied up? This earnest money you cannot use on another contract until it is fully released back to that buyer, which, like we said, could happen sooner, but it could be 14, 17 days from now. Well, seller number 2 may not wait 17 days for earnest money on that contract. So that's one issue to consider. That would be if a seller does not sign the release portion of a TNR and the holder has to write this 10-day letter. Now, another situation could be that, let's say a buyer terminates under a financing contingency. Well, in both the GAR and the RE forms contracts, it states that not only must a buyer send the termination notice to the seller for a terminating under a financing contingency prior to the expiration of that time frame, they must prove it with a loan denial letter. Now, in the GAR contract form, in the loan exhibits, it clearly states that the buyer has 7 days after the date of the termination to send the proof, to send the loan denial letter. In the RE forms contract package, that loan denial letter must be sent simultaneously with the termination notice. And that loan denial letter cannot contain specific reasons. And again, I've done several videos on this. This is all outlined in the contracts. In the GAR form, it is outlined in the actual loan financing exhibits, contingency exhibits. And in the RE forms contract, this is all outlined in the standard terms. But there are very specific reasons that a loan denial letter may not contain in order for a buyer to meet the financing contingency. But let's go back to the GAR contract. So if you are a listing agent and you receive a termination notice from a buyer requesting the earnest money back from the buyer based on not meeting the financing contingency, but you haven't yet sent the loan denial letter from the lender, well, a good listing agent is not going to encourage their seller to sign it, giving the earnest money back to the buyer until they get that proof from the lender, which could be an additional 7 days after that. So again, there is a delay between the buyer terminating a contract and actually getting their earnest money back should the loan denial letter meet the terms of the financing contingency. Another thing to consider is the holder of the earnest money. What are their policies regarding the form of the earnest money? Now, point of practice to you agents, you will be much better served, and your clients, both buyer clients and listing clients, will be much better served if you deal with certified funds for earnest money. If you deal with checks, license law states that the holder of the earnest money does not have to act on that check until there is proof that it has actually cleared the bank. So in keeping with license law, there are a lot of brokerages who have very specific policies on how long they must hold a personal check before turning around and dispersing the money that was given in the form of a check. A lot of companies have 10 banking days. So let's say, for example, a buyer goes under contract with the seller. They have a 12-day due diligence period. Buyer changes their mind or terminates the contract for whatever reason on day 3 of the, or day 4, whatever, of the, from the binding agreement date. Their earnest money was in the form of a personal check. Well, let's say they send the TNR over to the seller signs it, so we have a fully executed agreement to release the earnest money back to the buyer, but that personal check has not seasoned yet with the holder. So the holder is not going to release those funds back to the buyer, or they're not going to make them available for that buyer to use on another contract until the 10 banking days. So regardless of who the holder is, definitely you need to find out that policy for your own brokerage, and whomever you choose to be the holder of the earnest money in any contract, you need to find out what their policy is on dispersing funds that were received in the form of a personal check. And a lot of small businesses writing money on a business check, a lot of brokerages look at that as a personal check too. Again, point of practice, it's always best to deal with certified funds when talking about earnest money. The turnaround time on that is much quicker because the funds are more readily available once they are on deposit. Another question that comes up. So those are just a few of the many issues to consider when you are having your meeting with your buyer and you are discussing earnest money and how that is handled, what that means, and when they're going to get it back. Again, when an agent tells a buyer your earnest money is completely safe and it will be returned, we have protections with the due diligence period. We have protections with contingencies. It depends. And a buyer hears it's safe and they're going to get it back. A buyer hears they're going to get it back immediately, but that may not be the case. Again, depending on the contingency, a buyer's termination may not meet the actual terms of the contingency. Financing contingency is a notorious one where the loan denial letter, no, the buyer's not going to get funding, but the loan denial letter does not meet the terms to protect the buyer's earnest money per the agreement that they agreed to under the financing contingency exhibits. So just take a look at that. That is definitely worth a discussion with your buyer to discuss that. Now, a couple of other issues while we're on this topic. Number one, earnest money is not required. Earnest money is not the consideration of a contract, so it is not required for an enforceable contract between a buyer and a seller. So that's number one. Number two is what happens if earnest money is dispersed, the holder's holding it, you get a TNR fully agreeing for the earnest money to be dispersed back to a buyer, but the buyer wants to keep it on hold with that holder and write a contract number 2 and use it for that. That can't automatically happen. That earnest money is in the file and attributed to the purchase and sale agreement for property 123 Lucky Street. Just because it is dispersed, it now, once it's dispersed, once a TNR is signed or a 10-day letter has been fully done and executed and released, that those funds then belong back to the buyer. So the holder cannot automatically now attribute them to another contract without the buyer's written permission directing the holder to now attribute those funds from 123 Lucky Street to 456 Fortune Lane. So at Maximum One, we have a form. It's available for you in the reference section of Paperless Pipeline that says transfer of earnest money from one property to another. And we require that a buyer sign that, directing us as holder to transfer those funds from a property that was terminated where those funds were released back to the buyer, where we don't actually cut a check and give it back to the buyer and they turn around and give us another check. We hold it, but now we can attribute those funds to a different property address. Again, must have the buyer's written direction signed by the buyer to do that. Again, if you're a Maximum One agent, go to the reference section of Paperless Pipeline, and it is called transfer of earnest money between properties. The other thing that I want to address is if a contract is terminated prior to the obligation for the buyer to have remitted the funds, you still must address the earnest money in the termination. Easy way to think of it. If earnest money is addressed in the creation of a contract, it must also be addressed in the termination of a contract. So, for example, let's say you are binding on the GAR purchase and sale agreement, and let's say in paragraph paragraph A7B, it says earnest money shall be remitted X amount of dollars within so many days from the binding agreement date. So let's say you put in there 5 days from binding agreement date. And then let's say that the buyer actually terminates on day 3. So their obligation to even remit the funds has not yet expired. You can't just leave the release portion in a TNR blank. You have to address the earnest money. So all you would do is in the TNR, you're going to terminate under due diligence, and you would put buyer to retain in the release portion. You're going to put buyer to retain funds, to retain earnest money, not yet remitted per paragraph A7B of the purchase and sale agreement. So that's what you would do in the GAR contract. In the RE forms contract, same thing. You address the fact that earnest money was addressed in the creation of the contract, but it was not yet remitted, so buyer gets to retain those funds, and you address the paragraph where it talked about when the buyer was to remit those funds. What are some other issues you guys have had with earnest money? Comment below. Thank y'all so much for watching. Dana Sparks, broker of Maximum One Greater Atlanta Realtors, satisfying your needs with service, innovation, and education.